Hey everyone, welcome back to NIM's Adventures to Financial Freedom. Today we are taking a deep and honest look at ULTY. Recently, Mike Cow spoke on CNBC and explained what has been happening inside the fund and why the strategy is shifting. I went through his explanation myself and rebuilt it into a clear, simple breakdown so you can understand the full picture. The fund had an incredible run this year, then it suddenly pulled back hard. But behind the scenes, there are major structural upgrades happening, and I want to walk you through them in a way that actually makes sense. Let's get started. ULTY behaved like two completely different ETFs this year. From April until early October, performance was impressive. Total return was more than 50% with reinvestment. Then the momentum flipped. From the October peak until late November, the fund dropped around 18 to 19%. The big question is why this happened. The answer comes from how the old system picked stocks. The previous model focused on high volatility. More volatility means more option premium. So the basket included high beta names from different areas: growth stocks, crypto-related stocks, fintech, space tech, and more. This usually creates variety. But when the market enters a fear cycle, something else happens. These types of stocks start moving together. A heavy sell-off in Bitcoin triggered a fast drop in crypto names. But then, other high-volatility stocks dropped too, even though they were not connected to crypto. This is called a correlation spike. During stress, everything moves in the same direction. That is what caused the sudden drawdown. It looks like the ETF is now being upgraded to avoid that situation in the future. The new system seems to have more than look at volatility. It layers multiple checks. Instead of grouping by category, the fund now checks how each asset behaves during past stress events. Names are included only if they move differently from each other. Gold and gold miners were added because they act differently from tech or growth. They reduce overall shock. Companies with falling revenue expectations or negative earnings revisions are less likely to enter the basket. Extremely expensive names with weak revenue are avoided because they fall the hardest when the market turns negative. Stocks with strong positive news flow often outperform in the following month. This helps filter out unstable names. The model now uses tools like the 50-day moving average and RSI to avoid buying into steep downtrends. These adjustments make the portfolio more stable without removing the yield focus. ULTY is also moving through a reverse split. This is not only cosmetic, it also helps with option precision. At $4 a share, option strikes are spaced too far apart. A 50-cent strike step equals more than 12%. This makes hedging rough and less accurate. After the split, the share price should be closer to $40. This gives the fund tighter strike choices and much better control over risk. Everyone loves high yield. Nobody enjoys watching the NAV drop. The updated strategy aims for a healthier balance. It keeps the income focus, but reduces the size of major dips. Other income strategies that use similar filters already show that it is possible to beat the market with smaller drawdowns. ULTY is moving toward a more stable version of high yield. Here is what the new ULTY looks like. High volatility names will still be part of the basket, paired with larger and steadier companies like Google or Costco. Gold-related positions help balance risk. Correlation filters prevent a full basket drop. Fundamentals and valuation screens remove weak links. Technical tools guide timing. The reverse split improves accuracy. The option structure includes stronger protection. The goal is smoother performance with fewer painful swings. These upgrades mark the biggest evolution the fund has had since launch. If the model works as designed, ULTY should deliver more stable results during rough markets while still generating strong income. And just like I said in my last episode, I am currently holding my ULTY position, but I am not adding more shares, and I am not selling. I want to see how these changes actually affect the fund before making any new moves. Now I want to hear from you. Did you sell your ULTY position, or are you also waiting to see how the new strategy plays out? Let me know in the comments below. If you enjoyed this video, hit like, subscribe, and ring the bell to follow the journey. Your support helps this channel grow and keeps the message of dividend-powered freedom alive. Thanks for watching, and I'll see you in the next episode of NIM's Adventures to Financial Freedom.